an investment manager with WNT Ventures based in New Zealand. WNT does have a geographical focus on New Zealand, but I've also had experience founding and working in the Australian medtech ecosystem. With WNT's investment thesis, we're not just medtech, we're all things deep tech. Medtech is included in that. And what we're looking for is IP rich, science and research-based opportunities that have they're unique globally and have sustainable competitive advantage. We invest at the pre-seed and seed stage, and we are sector agnostic, except that we don't do biotech and pharma.
Understood. Thank you. Wei, please go ahead.
Yeah, sure. Thanks, Frederick. Hi, everyone. This is Wei from HealthXCapital. I myself, I'm the combination of a scientist and venture capital for past 10 years. And we do the investment, HealthXCapital, we do the investment basically to the to those like who just start their first institutional round. So that could be like a seed or maybe pre-A, something like that. And we are very focusing on to medtech innovations like minimally invasive surgeries and also digital health. So that could be extended to like consumer health or maybe like combination of therapeutics and the app or even like a medical device. But we don't touch any like deep biotech or any pharma applications. So it's a quick about that.
And you're based in Taipei, Taiwan. Do you invest outside of Taiwan as well?
Yeah, actually, we do the investment globally. Like we just completed a transaction. Well, actually not the transaction, but we just completed a deal in France. So we don't have any geographical limitation.
Okay, excellent. Jimit, please.
Hi, good morning and good evening, everyone joining in on this panel. I represent HealthXCapital. HealthXCapital is an early stage venture capital fund based out of Singapore for healthcare, exclusively focused on healthcare. We typically look at pre-Series A to Series A kind of deals, and our focus is primarily on health tech. That includes digital health solutions, consumer tech, med tech, diagnostics, AI solutions. We also do not touch the life sciences side of things. We do not look at pharma and biotech. As mentioned earlier, we look at pre-Series A to Series A, and in terms of geographical focus, we invest globally. But the key criteria for us is that solutions or the products should have applicability in emerging Asia and should be helpful in solving accessibility and affordability problem that we are facing in emerging Asia. As my background, I've worked as part of the commercialization as well as the diligence team at Apollo Hospitals, India, which is one of the largest hospitals in India. So there I got the experience on the commercial side as well as on the emerging side.
Great, thank you, Jimit. Thank you all. As we perhaps reflect on some of your investments that you have made, some of your maybe favorite startups, best investments that you made, maybe describe to the audience here a bit about the qualities that you'd like to see in a company's CEO and a founder, what you'd like to see in a management team. What is it that makes up a great company? And feel free to make any specific examples out of your own portfolio or keep them anonymous as you wish. And maybe Wei, I'll start with you.
Sure, of course. I think I myself and also our company is very focusing on to the CEO and the top management has very strong understanding about the market they are going to. And also I believe like all of you guys will be agreeing me like whoever knows like how to execute their the following steps, Of course, like we started the startups from day one with limited resource and of course like limited achievement, but we know like what would be the next 10 or 20 steps to grow a company from 0 to maybe 100. So we believe like the visionary like will be the top of the quality we're looking for.
Okay, great. Joseph, your thoughts?
Yeah, I mean, at the stage we invest in, generally, that's the only asset that the company has, really the team. So we look for, the confluence of business, technical, and clinical experience and expertise. We look for certain qualities in the founders, namely creativity, adaptability, or pragmatism, and grit. We like the founders to be coachable because more often than not, maybe they haven't seen everything that's under the sun. So, you know, those are some of the key characteristics that we do look for. In terms of companies, you know, they have to be solving a really big problem. And by big, I mean breadth times depth. And they have to have an edge. And I guess most importantly, we have to get along with them. We have to, you know, it's a long journey together. We're going to be, quote unquote, a married couple for 8 years or so, potentially. And we have to be able to add value, and we have to be able to really get along across a number of levels to really minimize the risk of, you know, avoidable things derailing the company's success.
Right. And maybe before I hand over to Laura and Jimit, maybe you can also comment on whether there are any particular red flags that you come across when you look at a company that would make you particularly skeptical about an opportunity.
Sure.
Laura.
Oh, sorry, Brad.
Oh, sorry.
Yeah. With founders, I want to be backing a founder that has a big vision that if it doesn't scare them, it's not big enough. But at the same time, I want it to be a strongly held, a strong view, but weakly held. So willing to learn and not just doggedly chase what they thought was right, because most opportunities from the point that they start to the point where they find commercial success have significant changes to either the technology or the market, the customer. And if they're not willing to listen to the market and adapt, chances are they will fail. There's a few outliers where just endless belief in the vision paid off, but that's the exception, not the norm. One of the big red flags that we see that might be relevant for a decent chunk of your portfolio is our fund will never invest into a company that has a CEO that has a parachute. If they have either an academic career or another company that they are significant shareholders in, when times get hard, they will step back into the more comfortable roles. And so we need not only a life-changing outcome for success for that founder at the end, but we also need them to not have a parachute, so they're in it beside us, making it work.
That's a great point. Thanks for that, Jimit.
So I think my fellow panelists have covered most of the aspects, but a couple of points from our side. What we see in a CEO or the management team is, of course, the vision, and more than the vision, the hunger to make it big, the driving factor or the hunger behind the whole undertaking this entrepreneurial journey. And along with that, we also like to see the ability to balance between having the delegation done to the second line, as well as micromanage the whole thing together. So the control as well as delegation going together. In terms of red flags, a lot of times we see founders coming up with the retrofitment of their products into a need. So they do not have the clear idea of the need assessment. That is a big red flag for us. And the second thing is also tactical steps that are taken by the founders without overarching strategy. So that also becomes a very big red flag. So since we are in late stage, we do have some idea on these things happening before we come in.
Yeah, thanks for that. Joseph, Wei, do you want to comment on red flags?
Yeah, sure. It's kind of like a flip side of just echoing Joseph's point. Like, if the CEO looks not able to, like open-mindedly communicate with the investor, or even like a prospective investor, that would be a little bit worrying me, because I am not sure like how can we maintain the marriage, from now on. So I believe that would be a big flag for me to work with someone refuse to communicate. You don't necessarily to learn the investor, because like we all come from different space, and we don't all come from different professionals. So the opinions from each side may not be correct always, but we do like to communicate and also discuss and sometimes like brainstorming about some ideas because we have different perspectives. So if someone refuses to be coached or refuses to be open-minded, that would be a very significant point.
Right. Joseph.
Yeah. I think Wei highlighted one that I'm really quite passionate about, which is if the team is unable to take feedback constructively, that is a pretty red flag, because I mean, look, we haven't even invested in you, so we haven't even given you our money yet, let alone afterwards. You know, you might just, you know, take the money and become a different person. And that's kind of one way to test for that, not the only way. There's tons of red flags. I mean, you could probably spend the whole hour talking about investment red flags, but the other one that I think is really quite important is anything that makes you question your trust. So treating the investor like, I don't know the right way to put it, but let's say, I'll use a tangible example. A competitive analysis which is incomplete, which your investor is obviously going to complete for you. I think that's the most common situation where you don't, and that to me indicates two things. Number one, you're trying to pull the wool over our eyes, or number two, you haven't done your homework, and both of these are really bad. But basically it's that sort of thing. You want to be as open and as transparent to build that trust, because especially now, because we can't even meet you in person.
Yeah, that's all. These are all great points. Thanks for that. We have, as I think you've all seen, a range of startups in our cohort that are very different stages of development. Many of them are at sort of the seed stage. There are a few that have raised Series A or even later. When is it a good time for a startup to first approach institutional investors? Should they be thinking about this immediately after they raised money from friends and family? Or should they do it after they've successfully hit certain significant milestones? Because there's always this trade-off between bringing in institutional investors too early and having to perhaps compromise on valuation. What are some of your thoughts on the timing of early stage startups reaching out to institutional investors? And maybe Joseph, I'll turn back to you on that.
Cool. That's a tough question, because I think the answer to that is it depends. It depends what you want. And I think that's the very first thing a founder and the team needs to decide is what do you actually want? Why do you want this institutional investor? Do you want them for network? Do you want them for name? Do you want them for governance? Do you want them for bragging rights? I mean, what do you want them for? And when do you want a decision to be made? That's another question. So you can reach out to them even before you have a company saying, hey, I exist, I'm on the radar, keep track of me, can I add you to my monthly mailing list or something like that. I'm more of the fan of get familiar with someone over time. So it's never too early to start talking to an institutional investor. There is a nuance on when you should start asking them for money.
Right.
Because maybe you should start asking them for advice immediately, saying, hey, I'm doing something really cool. If you have a few seconds, can you give me some pointers on where I should be really focusing my efforts? Am I going on the right alleyway? And then you're building a rapport, you're building trust, you're building that relationship, assuming that the institutional investor is even somewhat remotely interested in what you're doing, which you'll figure out pretty quickly by the speed and verbosity of the replies.
That's a good point. Maybe Laura, do you want to comment on that as well?
Yeah, I always tell folks it's never too early to have a conversation, but there's definitely too early to write a check. It is a double-edged sword having those early conversations because you are going to make some mistakes and things can change, and sometimes things can change dramatically, and you don't want to look like you're ping-ponging. You want to look like you are moving towards an increasingly focused goal. And so having those conversations, if you don't keep up the conversation well, or if you look like you're ping-ponging, you can actually decrease your attractiveness to that investor. So if you are going to go for an early communication strategy, have an actual communication strategy and execute it.
Yep, good point. Switching topics slightly, we're in the midst of a major pandemic here, and I wanted to ask you if you've seen that impacting the way that you invest. Does it impact? Do you still invest in new deals at all? Have valuations dropped? How has the pandemic affected? And maybe I'll start with Jimit here. How has the pandemic affected the venture financing environment in Asia Pac as a whole, Jimit?
So there is definitely a big impact that has happened, especially in Asia Pac. If we look at the recent report from Gallant Growth Asia, we have looked at a significant decrease in the number of investments, both by volume as well as by value. But what we see is in the long term, this is a positive impact because the emphasis of having health tech and healthcare has increased multifold. And that's why this is going to be a positive impact going forward in mid to long term. If I come on the HealthXCapital side, we are still looking at the investments. We are still maintaining the status quo as before the COVID scenario. We will still be looking at 3 to 4 investments in a year that we used to look at in past 2 years. In fact, we are in midst of doing a deal right now as we are speaking.
Good.
And also the things that we look are going to change is that the face-to-face meetings are going to go down significantly. There may be a situation where the deals are done practically virtually with just 1 or 2 meetings face-to-face. So that is a change that we are seeing.
Yeah. Wei, do you want to comment on that as well from BA Capital's point of view?
Sure. Yeah. Taiwan is a little bit different from the other sides because we are not really being impacted by the pandemic this time.
You managed it very well in Taiwan. That's true. like New Zealand, which I'm not asking Laura.
Yeah, so the communication and the interaction here is the same, but for those communication outside Taiwan, I have to say it got a little bit delayed, especially I know some firms or maybe captors, they have the rule to have the on-site visit before they before they make the decision. So I would suggest the teams to have a even longer timeline because usually I would suggest the startups to prepare at least 6 months for their fundraising. But right now, I would say you better to have maybe 9 months or even a year to to have the preparation. So I believe the time will be delayed. And as to the valuation, because VC, they won't be affected if they don't invest, but the startups, you are burning the money every single day, so that may be make you put you into some kind of a desperate situation. So I believe the valuation will be decreased a little bit.
Thanks. And given that the pandemic is not likely to go away anytime soon, and this is maybe as a quick question to all of you, would any of you invest in a company that you've only met through Zoom, that you've never met in person? And that I can ask Laura. So what are your thoughts? You want to start on that, Laura? Just a quick reply.
Yeah, that's a really tough one because so much of it comes from the interpersonal, and it's very difficult to get those cues completely virtually. What I can say is that we are doing increasing levels of attempts to assess the key things that we're concerned about in kind of communication, written communication, and just asking them to do something and seeing how they respond because we aren't seeing people in person. Now in New Zealand, we're just at border controls now, so everything else is really business as usual. So we are back to being able to see people in person. That being said, I went from traveling most of the time to I don't have another trip booked for 2 weeks. So we're not seeing people in person nearly as often.
Thanks. Joseph?
Oh, boy. Probably not. And this is because, I mean, the stage we're investing in is so dependent on the actual team that it's really, really difficult for us. That being said, we are experimenting. And I think the onus is on the investor to make it work because you have a job to do. You need to deploy the capital which your LPs have entrusted for your safe custodianship and growth.
Right.
So I'm becoming more of a fan of try before you buy. And it's gonna be a lot more difficult, a lot more work, and a lot more selective in that you'll need to start working with the startups before you actually invest in them. And that could be, can you get them to work with your other startups? Can you get them to partner with some of your network? Can you get them to, you know, test some of their technologies with some of your academic partners so you can build that rapport and trust over time, as well as be in a number of situations, some good, some challenging, that really give you an understanding of what makes this team tick. And I think that is the only way that we'll ever be able to do a deal remotely.
Right. Jimit, would you invest over Zoom? Yes or no?
Not entirely. As I said earlier, we are experimenting. We are taking most of the things virtually, but 1 or 2 meetings would definitely be required. But having said that, as I said, we are experimenting and we are in midst of a deal, which might be a situation where we have to do the whole deal entirely on Zoom.
Right. Wei, your thoughts?
Yeah, I would say yes, but there's like some, we only do the investment to those things we have some trustworthy common friends like that. So just like I mentioned earlier today, like we are going to invest in company friends just because like we have very close KOLs are working with them. So in that way, it's like we can believe in what they are doing. So that can kind of reduce the risk as to the integrity and also like the company existing, something like that. But outside of that, I believe that would be extremely challenging to me. So, but yeah, still the answer is yes.
Okay, good. Quickly before we move on to the topic of valuation here in just a minute, I wanted just to get your perspective of grants. There are a lot of different government grants available across the region from multiple sources. What is your view on grants? I've seen there are some startups that have even managed to survive for years and years only on grants, never raising money from a VC. Is it realistically a viable alternative to other sources of capital? And is there a downside for you as a VC when you come across a company that is only funded through grants and either government or other types of grants? And maybe Laura, I'll start with you because I know in New Zealand you have a number of grants as well.
Yeah, look, I think it's situation by situation. There's companies that, one company that's in our portfolio and one company that I keep begging them to take my money they're both heavily grant funded. However, the grants don't typically require capital efficiency or accountability or commercially driven milestones. And so continuing to have grant funding means that they probably haven't operationalized the business very well. And so I would then look for signals that they're going to be able to make that jump. A lot of grants also are very research or clinical outcome focused, and many of them, now some are beginning to have more commercial support, but many of them actually don't fund the commercial side of things. And if you haven't put any thinking into the reimbursement strategy, you don't necessarily have a business. You've got a technology, and I invest into businesses, not technologies. So making sure that you have an opportunity that isn't too anemic in critical parts of the business when you come to look for funding.
Yeah, great input there. Joseph, do you want to comment on that as well?
Yeah, generally speaking, I love grants, but you know, nothing's ever free in life. And one of the common pitfalls I see of companies that receive grant money is they somehow add it to their valuation, which speaks to Laura's point about capital efficiency. I don't look at it that way. And sometimes we walk away from deals because we just don't agree on this point, this fundamental point. The risk of grants is that it may also lead you on side quests that are perhaps distracting to your main business objective. And that too is risky because there is an opportunity cost in a finite amount of time. And if you're in any sort of meaningful problem, you've got competitors. But generally speaking, I love grants. It's cheaper than equity.
That's true. That's true. Good. Thanks for that. So that's a good segue for us to move on to the topic of valuation. And maybe I'll start with Wei on this. Should a startup indicate their expectation of what, or their view of their own valuation as they approach VCs? Certainly in their interaction with family and friends or angels, there will always be a question about that. Is that something that you expect to hear from the company that you're evaluating? How do you normally then assess that?
Myself, I'm fine with a team brings evaluation in their mind to me, but as long as they have a clear reference, like I need to see the rationale behind the valuation you're providing to me. Because like if you are just jump out from the university and telling me like, okay, I'm raising a capital at the valuation of 100 million, that doesn't make sense to me. But if you do have some evidence or maybe like a reference for me to back up your points, then I think that's okay. But I mean, anyways, like the valuation is a kind of like discussion between the investors and the startup. So I myself am neutral to that, but that won't be favorable to me. But sometimes, like if you don't have a clear mindset about like why you are bringing this number to me, that would be a strong negative factor to me, or even a red flag, because I know you didn't do your homework. So be careful about bringing the number.
Yeah. Thanks. Jimit, what in your mind drives valuation? What are some of the specific milestones in the development of a company that would really move the needle for you in terms of valuation? Would something, we spoke about grants, would that move the needle in terms of valuation? Would prominent board members, an impressive scientific advisory board, would those sorts of things move the needle, or is it more linked to clinical trial completion milestones or regulatory approvals and so on?
So the stage that we go in, that is the pre-A and Series A stage, we look more towards the traction, actual tangible milestones like preliminary clinical trial results, initiation of regulatory clinical studies, approvals, regulatory approvals, of even a submission of regulatory approval, things like that. Those are important milestones that move the needle. Of course, with that is the client list, order book, revenues, and things like that. So these are the tangible milestones that definitely move the needle for us when in the stage that we go in. But coming to the other part, the grants and advisory board and the prominent board members, those are for us good to have things, or actually the hygiene thing. It doesn't necessarily move the needle on the valuation, but if they are not there, especially the advisor and the board side are not there, that may turn out to be a yellow flag for us. Having said that, in the early stage, if we see, we have done a couple of seed stage deals. In that stage is the grants and the prominent board members and good advisors may move the needle to some extent.
Thanks. Laura, what drives valuation at WNT Ventures?
We spend a lot of time looking at capital pathway. There's obviously an incentive for investors to pay a lower valuation, and there's an incentive for founders to want a higher valuation, but there is definitely too low and there is definitely too high. And so figuring out what is the likely capital needs of this company over their pathway and work backwards from there to make sure that not only are we going to have founders that have enough of an upside at the end to make it worth all the effort, but also that we're not starting at a position that makes it very high risk for them to be able to back up that valuation on an expected uplift in between rounds. If they're not delivering uplifts in between rounds for previous investors, next round investors coming in are going to have a serious think about why not, and am I just signing up for another low to flat uplift. Right. So being able to deliver reasonable uplifts in between rounds over the lifetime of the fundraising efforts of the company is really critical.
Yeah, thanks for that. And Laura, I know you have to leave early, so just put your hand up when you need to go. I hope you can join us for a while longer. Joseph, how should a startup set valuation when they're raising money from family and friends, or should they just rely on convertible notes?
That's a good question. I think I've been quite vocal in my past about my rather dislike of notes and safes, but this is from an institutional perspective. I think from a friends and family round, I agree. I think that it's difficult to price something at that stage, and it's fair to kick the can down the road. The challenge is, how nice do you want to be to those early supporters? Because you can do things like, a time ratcheted discount rate, because you'll find that some companies are addicted to safes and converts, and they won't have an equity round until 3 or 4 years later. And that's not cool if you're paying a 10% discount on an uncapped note, because you've basically underwritten that risk for 3 years. So do you want to put a cap? Do you want to put on what a average valuation is for the expected next equity round? As I said, time ratcheted discount rate. Do you want to put an interest rate in or not? But yeah, I would agree. I think that if you're not a professional and you don't do this for a living and you misprice a company, you may kill it. And I've seen this happen. I've seen utterly mispriced early stage companies, which, like, what can we do? We might love what you're doing, but your investors will murder you because they can't take the ego hit of taking a 70% down round.
Yeah, that's a great point, and that perhaps brings us to the topic of term sheets in general, and maybe let's start with a cap table then. I think most of the companies that are in our cohort are familiar with term sheets. I don't believe all of them have had the opportunity to negotiate one. And maybe before we get into cap tables, who typically, in your view, should write that term sheet? Is it something that is expected? Does it always come from the investor, and if so, the lead investor, or is it something that the startup should come up with? I know that SVCA, the Singapore Venture Capital Association, they have some downloadable templates where you can see some template term sheets and contracts, and we can provide a link here. And maybe those of you who are based here in Singapore, Jimit and Joseph, you can maybe comment on if you've seen those, if they're useful. Otherwise, typically, where do the term sheets, where should they come from? And then we can talk about cap tables a little bit later. Maybe Joseph, you want to comment? Are you familiar with the SVCA templates?
Yeah, it looks fine. I think in terms of who originates the term sheet, if it's a friends and family round, or if it's kind of amateur investors or angel investors, I think that the company should originate that term sheet. However, it shouldn't be priced. It should be a convertible round. If it is an equity round and if there is a professional involved, the investor should absolutely lead with the term sheet.
Right. And the concept of lead investor, Laura, is that something that you, does WNT typically lead and therefore you take a lead on the term sheet negotiations? How does that typically work in New Zealand?
Yeah, we're typically the first and only institutional capital involved. We do co-invest and syndicate and would love to do more of that. But with our check size, we write $1 million checks at the first round because that's what they need to get anywhere useful. Usually that can cover off their first round, particularly if we're talking about a pre-seed. Seed stage, if the first time we're coming in is seed stage, we would co-invest. We often lead, but we are quite happy to follow so long as sometimes we need some flexibility in the terms that have already been negotiated so that we can make sure that the things that we care about are covered off. But that's all stuff that can be managed.
Yeah, thanks. And Jimit, you are familiar with the SVCA templates. You're okay with those as well? Have you seen them?
Yes, I have looked at them, and I'm familiar with those templates. To be honest, they are for us. They are a good starting point for the founders to look at the term sheet and to understand the different terms as well as the definitive term, because they have the templates for that as well. But that is nowhere that cannot replace the term sheet that an investor gives.
No, of course.
Every investor have their own form, and and the term sheet that is given, template that is given in SVCA, have multiple points taken from multiple investors, basically collecting all the inputs from multiple parts of the industry. So they may not be market standard, and there may be multiple options there which may not be necessarily required.
Yeah, good point. So let's come back to cap table. The cap table obviously is a key component of the term sheet. What are some, and I'll stay with Jimit here perhaps, what are some of your what are red flags that you see in a cap table? And is that typically linked to what might have happened at the family and friends round that we just spoke of, and how some of those tie-ups have been managed in the past?
So one of the major red flags that we often see in a cap table is that the pre-money calculation is not on the fully diluted basis. Most often than not, we have convertible notes converting alongside this round that the investor is coming in, or else the warrants are not taken into consideration, or some part of the convertible note like coupons are not taken into consideration and things like that. And if that happens, and after the initial discussion with the founders on this exact point, the founders, we see a reluctance from the founders to accept their mistake, that becomes a big red flag, because that is not, that goes back to the trust building side of things. The other two things that we see is a very small ESOP pool. Anything below 5% on the ESOP side is a big red flag. And the third thing is long list of investors who are sub 1% or sub 2%. Because that, from a governance perspective, becomes a big issue going forward.
Yeah, thanks for that. Wei, do you want to comment on that as well? Possible red flags you might see in a cap table?
Well, I mean, like for early stage companies, there won't be too many red flags to me, to be honest, because the combination of the investor and also the other factors. But in generally speaking, I think a couple of things will be raising some concerns to me. First is the portfolio of the investors. If you have too many individuals, more than 100 or 200 individual investors with very small amount, that would be a little bit worrying me, because I would guess you don't have a clear mindset about how do you raise your capital for the long run. And also, just echoing Jimmy's point, I want to see something fully diluted, and I can clearly understand what will be the percentage from each party. And I believe the last thing will be reflecting by the price per share. I want to know the logic behind that, because if the price didn't go smooth or didn't go well, I want to know what happened behind that, especially if you see some flat round or down round, that would be completely red flag, not red flag, but a complete concern to me.
Yeah. Jimit mentioned ESOP, employee stock ownership plans, and maybe Laura, I'll turn to you here. What are some of what would you like to see in terms of ESOP allocations, and are there percentages of founder ownerships that you'd like to see? Does that become a decision factor for you as an investor?
Yeah, absolutely. So we like to see the key people in the company have a life-changing event out the other side. That for me, that needs to be at least 10 million to the founder on liquidity. So usually I like to see founders at a bare minimum at kind of 60%, but ideally at those earliest rounds, still sitting at kind of 75% of the company. With ESOP, I like to see, 5 to 10% ESOP. And the reason why ESOP is so important is because as a startup, you pay pretty crap at the start. It's not until Series A that you can start to pay kind of market rates for the roles. And ESOP is a way that you can attract, the best people, presuming that you're in a market that people care about ESOP. New Zealand's a bit weird like that, in that Kiwis tend to just want cash in the hand. They'd rather have more money than the ESOP. They just don't value that long-term play. So worth considering the market they're in. I do just want to make 2 quick points on the cap table, and then I'm going to have to jump off. Apologies for that. If anyone does have any New Zealand specific questions, please do send those through to Frederick or Paul, and I'm happy to respond to those. But on the cap table stuff, one thing that I always look for is too many passive shareholders. At the earliest stages of the company, it's a partnership and it's a heavy lift. And if you don't have shareholders that are there to help you through the tough times, because things will get tough, COVID, you need to have the right people at the table. And so they're active, and it's smart money, that they actually understand the business that you're doing, the market that you're playing in, and when needed, if not proactively, then when needed, they can be tapped on to help the business.
Yeah.
Anyway, thank you so much for having me. I really appreciate it.
Great advice, Laura. Thank you for joining us. I know you got to run off, so we'll stay in touch and talk to you soon.
Great, thanks.
Thanks. So Joseph, maybe I'll turn to you then for that same question, your views on ESOPs and percentages of owners. And
yeah, I was surprised by Laura's comment on the Kiwis not appreciating ESOP plans, because this is something that we've seen in a lot of emerging markets where people live month to month, and revenue sharing or profit sharing incentives might carry more weight than an actual ESOP. I'm in agreement. I think 5 to 10% is fine, even if it's in a market that doesn't appreciate it, because it's better to create the ESOP earlier than to try to create it later to dilute previous investors who are probably not going to be happy about that, or you have to justify the existence of an ESOP too, especially if they're from that market which doesn't appreciate ESOPs. Because at some point, the company, if it's doing a good job, will go global, and you will need to hire people that do appreciate ESOPs. So the sooner the better. The other thing that I see as a red flag on cap tables is if the founders, well, 2 things. One, if the founders don't own enough of the company, which Laura covered, and for us at our stage, we like to see 65% to 100% ownership of the company by the founders, because sometimes we are the first investor. But also the distribution of the pool of founder shares amongst the founders themselves. If you have 4 co-founders, but founder number 1 owns 98% of the shares, I don't think the other people are co-founders. I think they're window dressing. And I've seen this a few times. So that tells you about the willingness of the founder to share. And if there's no founder agreements or ESOPs or anything, or even what's it called, like MSOPs, management share option pool, that support a more equitable distribution. It doesn't have to be, X divided by N, but something that shows true co-foundership, then that's a red flag to us. And we have walked away from a deal solely because of that reason.
That's interesting. That's a great point. Thanks for that, Joseph. Before we leave the topic of term sheets, I just wanted to briefly touch on anti-dilution rights, which is another one of those terms that startups and founders are likely to come across in a term sheet. And maybe Jimit, I'll turn to you. What are they, and is there anything that a founder can do to sort of optimize their position in view of the likely anti-dilution provisions that will get into a term sheet?
So in simple terms, anti-dilution provision is a downside protection for the investors. basically what investors are asking for is if there is a down round after the value that we have given in, we need to be protected for that down round. So effectively, we should be valued at the same down round valuation that you had after we came in. That's the anti-dilution provision. As I said, it is a downside protection. There are two broad methods in which anti-dilution works. One is called full ratchet downside protection or anti-dilution protection, and the other is broad-based one. Full ratchet is basically you have to give new shares, which affects the founder shareholding to a large extent after the down round is done. So most often than not, then we recommend a broad-based weighted average anti-dilution, which is one of the optimization methods that have come up in recent times. Therein, the conversion ratios between the preference shareholders and the common shareholders is adjusted so that the founders do not take the hit to a large extent. So we have seen that between the two methodologies, there is difference of as much as 30 to 40%. Having said that, one of the key things that the founders should look to avoid the anti-dilution is optimize valuation. It should not be overpriced, which is the common mistake that has been done and which leads to the kicking off anti-dilution provision. So that is the optimization we recommend to our founders, that it's okay if you are not overvalued and if you are not heavily valued, but you should not go down that route, especially consistently for 2 or 3 rounds.
Yeah, great point. Thanks. And in the interest of time, we'll move on to talk briefly about deal structure, and then we will break and we will go on to the Q&A. So for the our cohort participants, do start typing in your questions in the Q&A, and we'll start addressing those in about 5 minutes or so. On deal structure, we've touched on convertible notes. So maybe let me talk about the possibility of co-investing with a strategic, with a large multinational. And maybe I'll ask Wei to comment on this first. How do you see that? Have you done deals like that? And how typically does co-investing with a strategic affect your deal terms?
I don't really have any special comments on to co-invest with the strategic. Is as long as like the partnership with those investors is bringing a very good syndicate to the startup, because like sometimes that kind of strategic money may be limiting your market penetration. Like if you are working with a company in certain fields, then you may be blocking your opportunity from B or C, something like that, and that may bring like unfavorable exclusivity to your business in the future. So I don't think like in general speaking, I don't think like if you take the strategic money too early, is a good thing to you. And also I will suggest the startup to pay more attention to the information management, because like I believe some of the investor may ask for the information right, on top of the financial information, maybe like technology pattern or even like something special terms in accordance with the investment. So that will be like a significant negative to your business.
Okay, good, thank you. And Joseph, what are perhaps the most significant deal terms that a startup needs to be aware of and understand that could have very significant potential ramifications down the road, or deal terms that are sometimes overlooked by the startup?
Sure. Before I answer that, I do want to kind of respectfully disagree or maybe nuance Wei's comment about co-investing with strategics, because we do this quite regularly. I think it is dangerous to let a strategic lead a round, but if you as the investor are leading the round and bringing a strategic in, it's your rules, not their rules, and you have the ability to dictate the boundaries by which the strategic plays. I think it's very good to have a strategic involved early because it is de-risking the path to market. And you also have the potential to use the strategic's resources in an outsized way to differentiate yourself from the competition. Because if you're going with purely financial investors until market entry, then you have fewer vested interests to see the product become adopted successfully or integrate within your future acquirer's pipeline. I think if a strategic follows, that doesn't preclude other strategics from coming in, as long as the terms of that following are left relatively open. And again, that is your job as the investor to control that. So I wanted to just talk about that. On the deal terms themselves, I would really pay attention to the reserve matters and the warranties and representations. That is where the investor will exercise control, as opposed to focusing so much on the valuation. The other one is liquidation preference, and thankfully I don't see this so much in health tech, but I have seen some investors quite aggressive on the liquidation preferences, which basically means how many times your money do you have to get back before it goes to the common shareholders, or if it's a different preferred shareholder class, the other preferred shareholders. So typical kind of neutral is considered 1x, so at least to get your initial money back. I've seen liquidation preferences of 2 to 3x, which have been quite predatory. And so you might end up getting this beautiful valuation from a name brand, let's say $100 million. The next investor gives you a valuation of, $30 million. At face value, of course, you want to take the $100 million valuation. It's awesome. It strokes the ego. It shows that you're worth lots of money. But if that comes with a 3x liquidation preference attached to it, chances are you're getting nothing as a founder, unless you really, really hit it out of the park. So you have to really think about, okay, what am I going to exit at? What's the value of my company when I exit? And then similarly, you might get a really sweet financial term deal and have a whole ton of reserve matters that basically tie your hands, tie your feet, and put a masking tape over your mouth. Would you rather have that, or would you rather have the control and a lower valuation?
That's great feedback, Joseph. Really appreciate that. Now, I'm conscious of time here. We have plenty of questions that are queuing up here from our cohort that we'll take in just a moment. But I think this is the point in time at which we will end our live broadcast, because the hour is up. So thank you everyone on YouTube and those who are watching us live. And a big thanks to all our panelists for a terrific discussion. Do stay on the line. We'll continue in just a moment, but we'll end the YouTube broadcast here.